Very good morning, dear students. We are once again welcome to our 12th standard accountancy class. So today we are going to discuss once again cash flow from operating activities. A very important discussion, provision for tax and payment of tax. Okay, this is very important when you are going to work out for cash flow from operating activities. Here the provision for tax is an estimate of tax liability for a given year. Okay, so we already discussed this. As a tax paid, net of refund is deducted from cash generated from operations, or it may also call operating activities, to determine cash flow from operating activities. If the amount of tax paid is not given, it can be calculated by preparing provision for tax account. Okay, that's a very important discussion here. Suppose amount of tax is not given, we're going to prepare the provision for taxation account. Okay, this account gives information of tax paid during the current year as well as provision made for tax for the current year. Okay, two information are going to discuss for this preparing for provision for tax account. Okay, here you will see the format of provision for tax account. Here, see here, what are the payment of tax to bank account. Okay, this is tax paid. As usual, no, this is opening balance, by balance brought down. This is closing balance, two balance carried down. Here two information we can know for preparation of this provision for tax account. So one is to bank account. So how much you paid, that's what we will discuss here. Then here by statement of profit and loss, nothing but provision for tax made during the year. That you will see here. Okay, these two information we will get it. Once you get it, opening balance and closing balance of provision for tax. Okay, this is very important thing for format of provision for tax account. Okay, then suppose when both opening and closing balance of provision for tax are given and no other information is given, how you are going to do the work. Okay, your opening balance is treated as tax paid during the year. Then it's shown as an outflow of cash in cash flow from operating activities. So when our opening balance is given, we consider as a outflow for current year. Okay, tax paid during the year. Okay, shown as an operating activity. Similarly, closing balance is treated as tax provision made in the current year. Okay, it is added to the current year's profit. Okay, that's what with the format of preparing for net profit before tax and extraordinary items. There you want to add this. Okay, that's what the idea here. See one example here. The given Max Limited has balance in provision for tax account of 50,000 and 75,000 as on 31st March 2019-2020 respectively. Okay, here they given two balances, 50,000, 75,000. So it made a provision for tax during the year of 65,000. Here we want to know how much amount of tax paid during the year. That is missing here. Okay, now we are going to see the preparation of provision of tax account. First we want to enter opening and closing. Here by balance brought down. Okay, that's what your opening balance, correct? See, provision for tax account of 50,000, 31st March 2019. That is our opening balance. Okay, so provision for tax is a liability. That's where we are going to start from our credit side. By balance brought down, see 50,000. Similarly, to balance brought down 75,000. Then how much tax you paid? See, it made a provision for tax during the year 65,000. That we are going to do it credit side. By statement of profit and loss, provision for tax made during the year credit side 65,000. Okay, see this side credit side here. Okay, 65,000. So when you total this 1,15,000, we get the balancing figure of 40,000 to bank account. That is the entry here. Nothing but tax paid. Okay, that's what from the opening balance, closing balance, provision made during the year, you found now how much you paid during the year. That's what the question they asked here. Find out the amount of tax. Here the amount of tax is 40,000. So how you know this? We have to prepare the provision for tax account. Okay, that is very important. Then another example we are going to discuss. Statement of profit and loss for the year ended 31st March 2020. They given revenue from operation, nothing but net sales 16 lakhs. Then purchase of stock in trade 15 lakhs. Okay. Then change in inventories of stock in trade. They given note number 1. The note number 1 is they given here. See here. This is note number 1. See here. Note number 1. Changes in inventories of stock in trade. Nothing but opening inventories 1,10,000, closing inventories 1,35,000. The difference is 25,000, negative figure. Okay, that's what, because closing is more than opening. That's why 1,10,000 minus 135, you get it 25. The 25 only they mentioned here. See the bracket. That's what the explanation here. And employee benefit expenses 1,50,000. Then depreciation and amortization expenses 1 lakh. Then other expenses 40,000. We get it total expenses 17,65,000. Then net profit we get it negative figure, that is loss 1,65,000 in the bracket. So even though whatever loss we have to provide provision for tax. Okay, it's a mandatory. That's why we have provided 50,000. So again we shown as a bracket. So from 1,65,000, then less provision for tax 1,50,000. We get it profit after tax negative figure, nothing but loss 2,15,000. Okay. From this information, additional information they given both opening and closing of sundry debtors 1,50,000. That is our closing. Opening 1,25,000. Bill receivable they given 30,000, 40,000. Sundry creditors 75,000, 85,000. Salaries outstanding 15,000, 10,000. Okay. Then prepaid insurance 27,500. Opening current year. Then this is previous year 25,000. Then provision for tax 10,000, 15,000. Okay. Now we are going to prepare for the cash flow from operating activities. Okay. Here the net loss before tax and extraordinary items, we consider this figure. See here, before tax, we are going to take 1,65,000 directly because they are given provision for tax. So don't take 2,15,000. That is very important. You have to take 1,65,000 negative figure, nothing but loss. See, it's going to start from this. That's why you consider here, mentioned here very clearly, it is net loss before tax and extraordinary items 1,65,000. Within the bracket you are showing. Always should be very careful. Okay. Then you want to add non-cash expenses. As a depreciation and amortization, we given 1 lakh. See here, 1 lakh. See depreciation and amortization expenses 1 lakh. We are going to add once again 1 lakh. That's what we are adding here 1 lakh. Okay. Then you will get it operating loss before working capital changes 65,000. Okay. Then as you know, before working capital changes, what should be going to add and what should be going to deduct? That's nothing but here decrease in current assets and increase in current liabilities. That you are always going to add. Similarly, less increase in current assets and decrease in current liabilities. Now we'll see one by one. So here bills receivable. It is naturally it is coming under our current assets. It is 40,000 become 30,000. So it is decreased. That's why we always shown like this: 30,000 minus 40,000, 10,000. Then outstanding salaries. It is our current liabilities increased. 10,000 become 15,000. So, okay, then 5,000 difference. That's why we are showing here under the head increase in current liabilities. That's why we are going to add. Okay. Then both together going to add 15,000. Similarly, increase in current assets and decrease in current liabilities. Here sundry debtors increased from 1,25,000 to 1,50,000. That's why 25,000 we mentioned here. Similarly, inventories 1,10,000 become 1,35,000. So 25,000 differences increased. Similarly, prepaid insurance 25,000 become 27,500. So 2,500. Then sundry creditors. So sundry creditors here current liabilities, so it decreased from 85,000 becomes 75,000. That's reduced. Okay, 10,000. So all total together we get 62,500. Going to deduct. Okay, that's what you will get. Cash used in operation before tax, how much? 1,12,500. How see here once again? 1,65,000 negative balance. So 1 lakh going to add non-cash expenses. So naturally we get it 65,000 again bracket. 165 bracket negative balance. Then 1 lakh get it again 165. Then coming for here that 15,000 reduced again become 50,000 negative balance. Then 62,500. So this negative both together. So here also loss figure. Okay. Together again we get it loss. Here cash used in operation before tax 1,12,500. Again, now we are going to deduct income tax. So income tax, how we are going to calculate? That's what discussion here. From our problem, they given income tax here. Provision for tax, opening figure, closing figure. That's what 10,000, 15,000. This is our opening, 15,000 opening, 10,000 closing. Okay. From this information, here the provision for tax 50,000. For this, we are going to format this here. With the information, see you are going to prepare provision for tax account. Opening balance, I said now 15,000, closing balance 10,000, and similarly provision we made clearly 50,000. So here how much you paid bank to tax paid, balancing figure 55,000. Okay, From this information, from this working notes, this 55,000 we are going to posted here. See, income tax less. Finally, you get it. Cash used in operating activities 1,67,500. That's why here provision for taxation account you should know the format. Okay, how to have to do. Again, once again I'm telling you, opening balance, closing balance, the provision made here. So here, how much you're going to tax pay. Sometimes they given tax paid. With missing information may be provision, or sometimes they will give an opening, missing information may be closing. That's why here you will discuss very detailedly for the preparation of the provision for tax account. Okay, so provision for tax account okay, very important. So now we move for preparation of fixed assets. This is also one of the important discussion here. Here the fixed asset account. If you are strong in your +1 for depreciation chapter, this preparation of fixed account is very easy. Okay, you know already there are two type of depreciation calculation. One is return on value here. The fixed asset account based upon return on value, we are going to discuss when the balance sheet does not have an item of provision for depreciation or accumulated depreciation for both the years. So no question of preparation of separately for accumulated depreciation. Okay, it means that the fixed assets are shown in the balance sheet at their return on value. That is costless depreciation directly. So after deduction of depreciation, they are shown directly. So fixed account is prepared on the return on value basis. So in this case, the amount of current year's depreciation is credited to the fixed asset account. Okay, see here the format of fixed account here. See again same manner. As asset, you know, fixed asset account coming under discussion according to return on value. How we are going to prepare the fixed asset account. Here opening balance, see mention here opening balance. As asset, opening balance coming under debit side. Similarly, see here closing balance. Okay. Then how much, suppose any sale of asset, you going to prepare journal entry, correct? Bank account data to asset account, you credit by bank. So that's why bracket sale of fixed account. Then, so which account we sold, that account going to prepare for the any loss or gain. That's why by loss on sale of fixed account. Okay. Then particular asset account, sale of asset, what's the depreciation here? Mentioned very clearly here. Suppose sale of account, any gain, you have to show in a debit side. See here to gain profit on sale of fixed asset account. Okay. So then again to bank. Here nothing but again any addition for the asset during the year. Okay. That's why if you are strong in your depreciation chapter, you will +1. Here now very easy for preparation of the fixed asset account. That's why here once again I am telling you. See two balance, opening balance, here closing balance, then any sale of asset by bank account. Okay. Suppose any purchase of account to bank, plant account data, any asset to bank. Okay. By bank means sale of assets. To bank means purchase of assets. Here suppose at the time of sale you got any gain. That is more than the cost value, you have to show debit balance. Suppose any loss, credit balance. So the particular asset you are going, which asset you are sold the particular asset, that is a sale of asset, you definitely going to prepare the particular asset depreciation that is shown here. So this is the format very important for preparation of fixed asset account under return on value. Okay, here I will show you once again here. Okay, then again fixed asset account on the original cost basis. Okay, the second one, straight line method, correct? If the balance sheet has an item of provision for depreciation or accumulated depreciation, it means that fixed assets are shown in the balance sheet at their original cost. Suppose in a balance sheet, they separately show in accumulated depreciation account. So always assets shown as a original cost, in a cost price. Okay, original cost. That's why we are going to prepare here two accounts. One is fixed asset and provision for depreciation account should be prepared to determine purchase and sale of fixed assets during the year. By preparing provision for depreciation account, amount of depreciation charged during the year will be determined. Okay, that is the very important information here for the purpose of preparing here two account going to prepare in a original cost basis. Fixed asset account, then you have to prepare provision for depreciation account separately. For this manner, fixed account always shown as a cost. Okay, see here. Format. Same manner. Fixed asset account at cost. Already you know what is our opening balance. See closing balance we mentioned here. See here closing balance. Okay, again a sale of asset by bank, then purchase of asset to bank. Similarly, any gain, any loss here. See any loss. Gain is debit side, loss is credit side. Same manner. The only difference here you accumulated depreciation account you mentioned here. Okay. That is there you mentioned depreciation account. Here you have to mention the asset which you sold, you shown asset accumulated depreciation account. Okay. That's what the here important thing. Okay, again opening balance, closing balance, thereafter by bank, to bank, then to gain, then by loss on sale of fixed asset. Okay, here there you are showing depreciation account, here you are showing accumulated depreciation account. That is the only difference. So for that again you see this is this accumulated depreciation account. One more account you are going to prepare. See here you are posted the accumulated depreciation account here credit set, correct? See here accumulated depreciation account. See here this side accumulated depreciation account here. Okay, for this you are going to post it here to fixed account. Okay, that is the entry here, correct? So accumulated depreciation account data to fixed account. See here the particular asset sold, you want to prepare separate depreciation account. Similarly here also opening balance, closing balance, then only you know the depreciation for the current year. That is the very important information. While preparing this accumulated depreciation account, we'll get that information. Okay, now we are going to prepare, see, treatment of depreciation. That's one important thing. See, depreciation is shown as an expense. Okay, the statement of profit and loss to determine profit for the year. It is a non-cash item, correct? It does not involve payment in cash, but it is an allocation of cost of fixed assets in a systematic manner over their useful life. Okay, therefore, again, we want that depreciation is added back to net profit before tax and extraordinary items while preparing for calculating cash flow from operating activities. Okay, that's what the treatment of gain or loss on sale of fixed assets that I was going to given a treatment here. Once you know loss on sale of fixed asset shown as an expense in the statement of profit and loss. Okay. Similarly, gain is shown as a income statement of profit and loss. That's why the net result of realized value and book value of the asset sold. Okay. So that's why loss on sale of fixed asset, again you want to add it back. Gain on profit on sale of fixed assets, earlier you shown as income, now deducted. Okay, from net profit before tax and extra items for arriving at cash flow from operating activity. That's why depreciation is very important thing. Okay, three things we discussed here. One is for provision for tax, then second thing is fixed asset account, and third thing is how we are going to give the effect of depreciation. Okay, now we will see this problem, we understood everything. See here, calculate cash flow from operating activities from the following information. The given opening balance and closing balance. Okay, surplus as you know from the profit and loss account, 30,000, 35,000, general reserve 10,000, 15,000, then provision for depreciation on planned 30,000, 35,000. Thereafter outstanding expenses 5,000, 3,000. Okay, then goodwill 20,000, 10,000. Okay, then trade receivables 40,000, 35,000. Then item of plant costing 20,000 having a book value of 14,000 was sold for 18,000. Okay, that is a very important thing here. Okay, see here the plant cost 20,000 and a book value of 14,000. So difference is what? The 6,000 was sold for 18,000. Okay, here once preparation of the asset account only you know whether you sold asset for loss or profit, then what is the depreciation calculation here. That's a important thing we will discuss here. Okay, now going preparation of the cash flow from operating activities, as you know net profit before tax and extraordinary items. How you know? From the differences. Okay, see here opening balance and closing balance. Okay, for that you are going to, how you are going to prepare this net profit and extraordinary items. Okay, 10,000. See here, that's what that was shown, working notes here. The net profit before tax and extraordinary items. First of all, difference between opening balance and closing balance, you get it 5,000. Then you want to add general reserve, transfer to general reserve, correct? 5,000. So you get it 10,000. That 10,000 you are posting here, correct? See here. Net profit before tax and extraordinary items 10,000. Then add non-cash expenses. As you know, here how you are going to calculate depreciation. That's why the discussion here. Before you are going to prepare the second one, see here. As you know, on opening balance we know the cost of the asset. Two balance brought down 20,000. Okay. As you know how much we sold, 18,000 we sold. So naturally how much gain you got it. See here provision for depreciation they given. 20,000 is the cost of the asset, 14,000 it is the, see here, 14,000 book value. So plant costing 20,000 having the book value of 14,000. So naturally difference is 6,000 is our asset. How much is sold over 18,000? Okay, see here. Okay, so how much is sold? So that's why by bank account sale of plant is shown. So nothing but plant account data, bank account data to plant account. That's why by bank account 18,000. Similarly, what is our gain? Okay, so 18,000. Here gain is our 4,000. Okay, because 14,000 is the cost of our asset. Okay, so for the 18,000 is sold. So naturally 4,000 is a difference. That's why the gain 4,000. Depreciation 6,000. From the 20,000 minus 14,000. Okay, that's what here. We got it, two information. This is for our gain 4,000, we got it. Similarly, depreciation calculation also we got it here 6,000. Okay, then your provision for depreciation account prepared. Again, by balance brought down. Opening 30,000, opening balance, closing balance 35,000 from the depreciation. Okay, see here, I'll show you once again here. Here. See, plant depreciation plant outstanding 5,000, 3,000. Okay. So that's what here we understood the preparation of plant account. For that we got it our depreciation and opening balance. So from the preparation of cash flow from operating activities, so that for before tax and extra items 10,000. So I discussed now, just now, depreciation on plant 11,000. Okay. Then goodwill amortized 10,000. We added 21,000. Okay. So totally 10,000, 21,000 added 31,000. Again non-operating incomes. That's what just now we got it. Preparation of a fixed asset, correct? Gain profit on sale of plant 4,000. Okay. Now we got it. Operating profit before working capital 27,000. Okay. Then, as you know, working capital changes. What should be added? Decrease in current asset, increase in current liabilities. Then less decrease in current assets, increase in current decrease in current liabilities and increase in current assets. Okay. Here, as you know, here, see one second, I'll show you the given. Here, trade receivable 35,000, opening balance 40,000, closing. So 35 become 40. So it is increased. That's why I shown in a trade receivable, correct? Decrease in current asset. 35 become 40, 40, then 35. Okay, that's what here 5,000. Decrease in current assets. See, I have shown it here 5,000. Thereafter, current liabilities, outstanding expenses. Okay, 5,000 become 3,000. Okay, that's what decrease in current liabilities. So 2,000. Okay, so here 27,000. Thereafter 5,000 added for our decrease in current asset. Thereafter decrease in current liability 2,000. We got it 30,000. Okay, from that we get it cash flow from operating activities. Okay, so that's why here you have to prepare working notes 1 for getting net profit before tax and extraordinary item. That is working note number 1. Thereafter plant account are going to prepare how to prepare plant account for this format. Okay, as you know this very well, correct? So how to prepare the plant account from the available information, opening balance, then suppose the given closing balance. Okay, then 18,000 how much you paid by bank, then to gain on profit on sale of plant 4,000, then depreciation 20,000 minus 14,000, 6,000. Okay, likewise. Then one more thing, provision for depreciation plant account, very very important here. Again, we are going to prepare here two accounts. One is plant account, another is provision for depreciation of plant account. Okay, again opening balance, closing balance. So how much plant for the particular sale of plant, what is the depreciation, that is the posting here, correct? This is 6,000 here debit side, see here 6,000 credit side. Okay, that's what the debit and credit posting. Thereafter we got it our depreciation statement of here 11,000, this 11,000. Okay, this 11,000 only we are going to substitute here. See here, this 11,000 depreciation and plant. Okay, so once while preparation of your plant account and accumulated depreciation account, then only you know this depreciation plan, this missing plan 11,000. That's why in this problem very very important for preparation of fixed plant account and accumulated depreciation account. Okay, that's a very very important discussion for this problem, especially for this. Okay, so accordingly you have to work out for the all the problem based upon this information available from the exercise. Okay, so thank you very much. I hope that you understood.